So here we landed. This is going to compare the expected historical move according to the option prices prior to releasing earnings versus the actual earnings move after releasing earnings. So when we look at this bar, you could see it starts from 0% going up and down. So I'm going to use this one I'm hovering over as an example here. So October 29th, before the market opened, the Shopify reported earnings. You see that the stock was down 4.8% that day. The straddle was implying a move of 6.6% prior to earnings. So you could see that that move was more muted than the straddle was implying. The green, that green bar, that's when the move was to the upside. So July 29th, before the market opened, Shopify reported earnings. That day they were up 7%. The straddle was implying a move of 8.1%. So that move was more muted than that straddle was pricing in. So let's take a look at the historicals. That in the last 12 quarters, the straddle overestimated the move 75% of the time. The average expected move prior to earnings was plus or minus 8.4%. The average realized move was 5.9%. So you could see there about a 2.5% differential between the implied move versus the realized move. That's why we see here that straddle was only profitable 20% of the time, and on average lost 24% after the day after earnings. And you could see here, where the time it broke through, like over here, here it came close, but this gives you a visual, and it looks like, at least from a historical perspective, when it broke through, it was really to the upside, so that's from the perspective of the move. Let's take a look at the implied volatility, what it tended to do. So this is going to look at an option that's 30 days to maturity. And the reason is when you look at the very near-term options, those have less vega, they have more gamma. So basically more of the move is priced into the very short term. As you go out further, the options have more vega, so there's a bigger implied volatility risk. So we're looking at an option with 30 days to maturity. And this is what that option tended to do. So on average, the implied volatility was down 18% day after earnings. So heading into earnings, the 30-day IV was on average 58. The day after, the average implied volatility fell to 47.9. 5 days later, it fell to 46.4. So it continued to decline 5 days later. So here, this is the average, 58. Here's where we are now. So right where the average is, 58.4. All right. And if you come down here, here are the historical snapshots of the implied volatility, heading into earnings, day of earnings, and how the implied volatility behaved up to 5 days after earnings. And you could see here the averages, the max and the min. Averages, max and min. Okay. So that's really quickly from looking at the straddle and the implied volatility. Let's take a look at what Shop did since it last reported earnings. So in this situation, actually, before I do that, we have some time. Let me take a look at what it did historically as far as that. So this is looking at the historical earnings. We're looking at what the estimates versus the earnings per share estimates versus the actual, also the revenue, the estimates versus the actual. So you can see here, the last time they reported earnings, expecting 51 cents, they reported $1.13, they beat by 62 cents. You can see the revenue, they're expecting 653 million, they reported 767 million, so they beat on that, but the stock was down 4.8%. So you could see they beat analysts' expectations, earnings, and revenue, but the stock was down 4.8%. So why is that? And you see this throughout, and I try to point this out almost daily on the show. So the reason for that is the following, there are two reasons. One is that these top numbers, they don't tell you the entire story. It's the story behind the numbers. What is the management saying about the future? What is their outlook in the future? Because even if you beat, right, and you could beat by a lot, but whatever you say, maybe you could say like, hey, our patents are running now, or you could say there's going to be new competition coming on board. So things that you say in that report will impact the stock. The other reason is that this stock price does not reflect an analyst expectation, right? The stock price reflects the traders' expectations who are buying and selling the stock, right? So it's not the analysts that are setting the market price. It's the traders, and it's really their expectations, and how and what does the stock do relative to the expectations of the traders. So it's the risk holders that are really, that's the important part. So let's try to gauge what they're thinking, okay? Like how our traders may be feeling about this next earnings. So one thing we could do is, first, let's just take a look at what we think the fair value is of Shopify, okay, and where it's trading. So this way we could kind of benchmark, well, where would Shopify be priced at according to their historical multiples versus today's price? So here I'll show you really quickly. This is looking at, in the last 3 years, what's the average on the last 3 years, what's the average PE ratio? So here it's pretty high. So we kind of skip that because it's not very stable there. So we'll go then default to the price to sales ratio. So the price to sales is the market cap of the stock divided by the total revenue it earns. And here we see that on average, it's been 54.8. Its average price to sales, we see it's much higher now. So if we go back to the average, that's where we are. We could also take a look at relative to the SPY. So I'm going to skip the PE because it's been kind of all over the place. We're skipping that. So here's Shopify's price to sales ratio versus SPY's. So right now you can see it's at a huge premium. This is the 3-year average premium of Shopify's price to sales versus SPY. If we revert to that, we're here. So we could see that if we use those averages right now, we're at a 31.5% premium. In other words, that currently the traders are giving it a higher multiple, higher valuation than average. So at least here they're looking a little bit more optimistic heading into this earnings than usual. I'm going to also take a look at the post-earnings drift. So this is looking at what did the stock do after reported the last earnings. So we know that we just saw after reported the last earnings, the stock was down 2.8%. Since then, we have about 3 months in between where the stock doesn't report earnings, but it can drift, right? It doesn't stay at the same level. It'll drift higher or lower. So here's this green bar here. Since then, the stock over here drifted higher by 49%. Well, how does that compare to what it does usually between earnings? So we see that the average drift historically has been up 19.9%. The average move up or down between earnings has been 16.6%. So that's a 3 standard deviation move to the upside relative to its historical moves. So at least here we're seeing that based on historical benchmarks, Shopify, the traders look like they're pricing in already a optimistic earnings report from Shopify. Let We ran out. We're right at 9:29, Will. So I don't know if you have one last question, but
well, really quick. Someone was looking at QS. It's its first earnings. All we could basically look at is what they're pricing the straddle at. Maybe a quick look. QS.